Hi, Brent Freeman with the CBB Group. In this episode, we're going to cover the 5 action items to prep your business for sale. So if you're a business owner considering exiting your business in the next 12 to 24 months, stick around. As always, if you've got questions as we go through this presentation, please feel free to leave them in the comment section below and I'll get right back to you. In addition, if you get something out of this episode, please consider hitting the like and subscribe button. And with that, let's get started. So, the number one action item is probably the most obvious when prepping your business for sale. And that's making sure that your revenue, your gross margins, and the company's profitability are growing year over year for the last at least 2 to 3 years. Now they can be flat, but obviously preferred that they be growing. It really helps with buyers. Buyers, when they look at a business for sale, they're looking at trend lines, and having that profitability and that revenue continuing to increase year over year decreases the risk of the business to the buyer and to the bank, makes it more saleable, and at the end of the day may actually help drive the value of the business up. So the number one item is increasing revenue, gross margins, and profitability year over year for at least the last 2 to 3 years prior to putting your business on sale. Action item number 2, creating a turnkey management team. Now you have to remember that buyers are buying a business, they're not buying the owner. So if you're an owner and you are the key person that drives everything in that business with regards to skill sets, whether it's bidding jobs, customer interface, or if that's, you take a look at yourself in the mirror and your business simply won't run without you, you need to think about replacing yourself. Take a look at the skill sets that you have or the job functions that you perform that could be done by others and start offloading those. So think about what you do on a daily, weekly, or monthly basis. Hire or transfer these skill sets to others in the business or considering outsourcing. So a couple of those key items are fairly easy. Bookkeeping, payroll, HR, those are issues that most business owners can actually outsource and has no effect on the day-to-day operations of the business. But remember, buyers are buying the business, not the owner. So creating that turnkey management team will broaden the buyer base and decrease the risk of that business being dependent on 1 or 2 people. Number 3, diversifying your customer base. So with customer issues, there's a couple things you want to take a look at. The first one is customer concentration, and that really is any one customer that occupies any more than 10 to 15% of the company's total revenue would be considered a customer concentration issue. Now, it's not uncommon to see small businesses with 2 to 3 customers that may occupy 20, 25, or 30% of the company's total revenue. But in today's interest rate environments and credit environments, it's important that you understand that the banks and the customers will look at that customer concentration issue fairly closely. And if it's too great, it can affect the company's overall value when you go to market and its bankability. So reviewing your customer diversification is very important, and it's one that you should look at every year, just regardless if you're prepping your business for sale, because it takes a period of time to diversify that customer base. The other thing with regards to customers, especially if you've got customer contracts, take a look at those contracts. If they're easily assignable or they're, auto-renewing, the things that you need to look for are really two, and that is when you sell the company, do you simply have to notice the customer that the contract that the business has been sold, or do you actually have to go get consent for that customer to actually transfer that contract? So two important things to look at, and obviously make sure that when you're prepping your business for sale, you look at all your outstanding contracts and you have them up to date, because that's something a buyer is going to look at. So number 3, diversification of your customer list. Number 4, financials. Companies' financials, what kind of shape they're in, how long does it take to close the books on a monthly basis, and then there's a couple, 3 or 4 things specifically that you want to address. And the first one is taking a look at your tax returns, the company's tax returns versus the internal financials. They should be fairly close, and if not, what's probably happened is your accountant has made adjustments to the tax returns before filing them without going back and making the corresponding corrections in your internal financials. So you want those two to line up as good as possible. They don't need to be exact, but this is kind of like horseshoes and hand grenades. It should be close. Profit and loss statements. So you want to make sure those are done on a monthly basis. Hopefully you're able to close your financials every month by the 10th or 15th, because as you go through this process of selling your business, we're going to want to make sure we're updating the financials as we put the business on the market. But when you enter into a letter of intent, the buyer will probably want continuing updated financials as they go through due diligence and the negotiation process. So you want to make sure they're clean and up to date. Balance sheets. Now this is one where we get off with small businesses from time to time, and that really is around inventory. A lot of small businesses don't take an actual inventory on a yearly basis, and they're just kind of guessing on their books. Well, when you come to a letter of intent, making sure that you have the proper inventory stated on the balance sheet is very important. So as you prep your business for sale, start taking a year-end inventory and making sure that that coincides with your balance sheet. Accounts receivable aging. Here's another area. If you've got debt or accounts receivable that is not collectible, charge it off, take it as bad debt, and get it on your tax returns for a prior year, but clean that up as you go through time. A buyer does not want to, if the accounts receivable are going with the business, have to work at trying to collect the accounts receivable. Fixed assets. This is another one where we see the fixed asset list not kept current on a yearly basis. So especially if you've got things like large fleets, you've got a lot of heavy equipment that you're using in the business, making sure you have a up-to-date fixed asset schedule is important. The other thing, if you've got work in progress, if you're a construction company or a manufacturing company, you've got to make sure that that work in progress or the WIP report is kept accurate and clean. And especially for construction companies, as they go through the year, trying to make sure that that WIP report is accurate will be really important. And then who's doing your accounting? So if it is, again, going back to the number 2 item, which is turnkey management team, making sure that if you need to outsource this, to go ahead and line that up and get that done. It'll just make the transition and bookkeeping and financials a little cleaner and easier to transfer to the next buyer. So, number 4, financials. Number 5, identifying key employees and developing a retention plan, or if that's not possible, making sure that, again, 12, 24 months out, that when you identify that key employee, you put some action items around hiring, training, and being able to disperse those skill sets that that person has. But you want to make sure that you don't have one employee that's going to hold the company hostage from being sold. So there are a couple ways to do that. A retention plan where you leave some bonus dollars behind to make sure that employee sticks around for a year may be something that you need to do. So number 5, it's a tough one, but identifying your key employees and making sure you've got a transition plan so that they can't hold your business hostage. Here's a bonus tip on prepping your business for sale, and it really doesn't have anything to do with prepping the business for sale, but as you enter into negotiations, understanding that a transitional training period is going to be required with the sale. Usually 2 to 4 weeks of transitional training is included in the purchase price, and then anything after that is usually put together as a consulting agreement at a market rate or pretty close to it. Now, a lot of sellers are ready to exit their business, just want to cash out, do what they need to do to transition their business and move to a sunnier climate, start playing more golf, or hang out with the grandkids more. But if you want to increase the salability of your business, really sit down and think about how you need to transition that business to a new owner. And if it takes you 1 or 2 months of working full-time in the business and being compensated after that initial training period, that's something that you should offer up front with the buyer. And here's why. A buyer's going to have a lot more confidence in making an offer if they know that you're going to stick around and make sure that they're successful down the road. Remember, if they're spending $1 million or $2 million, it's a big lifetime investment for them, and they want to make sure that you've got the confidence in them and that you'll help them be successful. It also decreases any risk associated with a seller note. So if you're financing part of the transaction, you're invested in making sure that you put together a good transitional training program to offer any new buyer. So again, transitional training increases salability and decreases the risk of the new owner not being successful. Well, there you have it, the top 6 action items to help you prep your business for sale. Again, they are revenue, gross margins, and profitability increasing on a year-to-year basis, creating a turnkey management team. Remember, the buyer's buying the business, not the owner. Diversifying your customer base, making, again, reducing risk and increasing salability. Getting your financials in order, addressing any key employee issues that you might have, and then creating a transitional training program to help the buyer become just as successful as you are. So as always, if you've got any questions, please feel free to give Bill or I a call or send us an email or leave them in the links below, and we'll see you on the next episode.